You can experiment with your investments. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like healthcare. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
If your investment portfolio was a novel, what genre would it be? Adventure? Mystery? Horror? I'm DeLegge with ETFguide. In reality, our investments are comparable to a movie, where each person gets to choose their classification. The bottom line is that the portfolios we assemble should accurately reflect our age, our financial goals, our capacity to handle risk, and our unique personalities. My latest portfolio report card is for RPV. He's a married 48-year-old man from Oregon. His wife is 45 years old, and they both work in the technology sector. Before analyzing and grading his portfolio, I asked RPV to describe his investing style. He told me, quote, "My wife is conservative and I'm aggressive, and since we're both doing fine with our jobs, the goal is to have growth in the portfolio," end of quote. RPV and his wife self-manage a family trust account valued at $823,708. Now, the portfolio holds 18 individual stocks, 15 mutual funds, 4 ETFs, and cash inside a money market fund. What kind of grade will RPV get for his portfolio report card? Before I assign him a final grade, let's see how he does in 5 key areas. Let's begin with diversification. Now, the hallmark of a diversified portfolio is that it's never concentrated in one stock or one mutual fund, but rather has adequate exposure to all the core or major asset classes. So how does RPV do? Well, he's got exposure to U.S. stocks. He also owns international stocks. He owns some bonds. He also has some exposure to oil, which represents commodities. He's also got some cash. Now, based upon my analysis, he does okay on diversification. The only major asset classes he's really missing is real estate and TIPS, also known as Treasury Inflation Protected Securities. On the other hand, for commodities, he is exposed to just one commodity, which is oil, and that leaves him obviously with room for improvement. In terms of risk, although RPV does describe himself as an aggressive investor, he told me that his wife is conservative. Now, since they both manage their money together, finding a healthy balance between these two opposite styles is something that they're going to need to do. Now, RPV's current asset mix has almost 60% exposure to stocks, 37% exposure to cash, almost 4% to bonds, and just under 0.5% to commodities. Now, although the overall asset mix isn't necessarily out of line with his growth investing goal, owning 18 individual stocks concentrates his financial risk in just a handful of companies. RPV's sizable cash holdings should cushion his portfolio from a decline and put him in a good spot to buy assets on sale when the stock market finally corrects. Now, the next question is, will he have enough discipline to take advantage of that opportunity? Next up is cost. The prudent investor deliberately minimizes their investment costs to the greatest degree possible. Why? Because they recognize that every penny paid in commissions and fees reduces their net returns. Now, in RPV's case, he told me that he does between 5 to 10 trades a quarter. And just like that, guess what happens? The cost for managing 18 individual stocks, 18 individual positions, can really begin to pile up very quickly. Now, for his mutual funds, RPV's 15 funds are on Schwab's no transaction fee list. And while it's good that he doesn't pay a commission to acquire the funds or to sell them, the ongoing operating costs for his largest fund holdings, like the FMI International Fund and the Loomis Sales Bond Retail Fund, are substantially higher versus competing passive index ETFs in the same category. Thankfully, RPV owns a few low-cost ETFs like the Energy Sector SPDR, ticker symbol XLE, which charges just 0.6% annually. His grade on cost, I say, would be acceptable if he held the bulk of his money in these types of lower cost vehicles versus expensive funds as he does right now. Next up is tax efficiency. Now, a portfolio that's tax efficient is orientated in such a way to reduce the threat of taxes. And the easiest way to do this is to have a tax efficient portfolio that has good asset location and that owns investment vehicles like ETFs that are notoriously good at minimizing your tax liabilities. Now, the tax burdens for some of RPV's mutual fund holdings, I would say, are eating him alive. The annual tax cost ratio for his largest fund holdings range from just under 1% all the way to almost 2%. And add that to the annual expenses of 1% that he already pays on these funds, and it's really a recipe for long-term trouble. Now let's look at the last category, performance. It's always a red flag whenever I grade an investment portfolio that's unable to match or exceed the performance of a blended mix of passive index funds or ETFs. Now, from August of 2013 to August of 2014, RPV's investment portfolio grew from just over $700,000 to $823,000 for a 17.5% gain. Some of his stocks like Facebook and Micron Technology really boosted his gains. Meanwhile, a portfolio of passive index ETFs that reflect an aggressive investor's same asset mix gained just 9.98%. So excellent job on performance. RPV beat the yardstick. In summary, RPV's final portfolio report card is B-. While this is a satisfactory grade, there's still plenty of areas for improvement. There's no denying that he hit the jackpot with a few really hot performing stocks, but becoming a better investor, not a better gambler, should be his ultimate goal. I think if RPV slashes the cost of his mutual funds further, if he cuts his tax liabilities on his portfolio and diversifies into areas that he lacks, I think his excellent performance will be a sustainable trend versus one lucky year. Take my portfolio report card challenge by going to portfolioreportcard.com. My simple grading system of A, B, C, D, or F helps you to understand the financial condition of your money. Oh, and one more thing. If your portfolio scores A, I pay you $100.